gold prices are going to continue to advance to higher levels, no matter where you buy it long term, 6 months, a year from now, those prices will be in the wind and you won't be able to buy at that level. My target right now for the conclusion, meaning when this motive phase completes, is going to be just shy of 2,700. That's been my target for a while. I did revise it once mid-year because initially I was looking for 2,500, and once we got close to that, I realized that was a little bit too modest of a upside target. And right now my target is and has been $2,700, not tomorrow, not next month, but by the first quarter of 2025.
According to the latest trade data from the Commodity Futures Trading Commission, hedge funds are starting to recognize the value of holding some gold and silver as money managers increase their bullish bets. In the case of precious metals, the secular gold bull market started in 1999. Some say it ended in 2011, but this isn't the case as the fundamental drivers remain in place, and the key Fibonacci retracement, 61.8%, wasn't broken. Gold is in its third great bull market since 1971, with prices up nearly 90% since December 2015. GaryWagner is a seasoned technical analyst and the founder of TheGoldForecast, where he provides in-depth analysis of gold markets and related financial trends. In his analysis, Wagner forecasted that current trends will allow gold to form a base at these new levels and gradually move higher without a significant long-term correction, like in 2011. Based on technical studies like Elliott wave theory and Fibonacci extensions, Wagner expresses confidence that if the market follows this model, gold will continue to rise with a strong corrective wave to follow. Concurrently, he suggests that now might be an opportune moment to buy on a dip, as long-term price increases could make current levels seem low. Central banks want to reduce dependence on the US-dominated global financial system, while Chinese savers and investors are not only culturally attached to gold, but have also been attracted to the metal's performance relative to their stock and real estate markets. We present the clips of GaryWagner's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
The key is this: the fundamentals that have moved gold prices to these historical levels are still very much in play and are still exerting the force that has been moving gold higher. As long as those forces are there, we can expect that gold will either form a base at these new levels for a while and then move up, or form a base and move up slightly, but that you won't see a major top and then a multi-year correction like we did in the middle of 2011 when we first hit 1900. And then many analysts, including myself back then, thought it was going to 2000. It hit 1900. It was like to the moon. And of course, that was fear of missing out. That was the whole strategy in which you saw something that had never occurred. This is different. And the reason I believe this is different is if we think about the chart that I just pulled up, where I show the multiple times that gold challenged 2,500 and went back down, the fact that it has now exceeded that and today moved below that means that this might be the point to add, rather than having added at $2,560, the recent highs that we got earlier this week. And so for that reason, you want to buy on a downstroke, so to speak. In terms of what I'm looking at in terms of potential, I basically have a much longer term view. This goes back to cover the entire year. This, of course, is 2023. The beginning of this year was defined as a corrective period called a corrective phase. I'm using two basic technical studies: Elliott wave theory, Fibonacci extensions, and retracements. And so in Elliott wave theory, basically, he believes that a market that moves will move in a defined pattern, which will repeat over time. If the fundamentals, the underlying fundamentals are causing the market to move to higher pricing, that's called a bull count. And so the first part is called the motive phase, and it's composed of 5 waves. Waves 1, 2, 3, 4, and 5, where waves 5, 3, and 1 are simply called impulse waves, meaning it's moving in the primary trend direction, and waves 2 and 4 are the corrective waves in between it. After you complete the 5th wave here, you go into a correction. The correction can unfold in a number of ways. In both cases, we've had a correction that was a asymmetrical triangle, meaning it had a flat bottom and a descending top, a series of lower highs here as well as here. And so according to the model that I've created here using Elliott wave, at the end of June, the clock restarted. So we got our wave 1 again. And just as we went 1 through 5 earlier in the year, I believe that we've completed wave 1, wave 2, and I believe that we are currently in our 3rd wave, which means that if this model holds weight and if the market unfolds in any way with a high correlation to this model, we will see gold continue to move higher. We will have a strong corrective 4th wave and then a final 5th wave. Following that, you will go back into a corrective phase. And I think that the moves that have no data because they haven't occurred yet, I believe will occur anywhere between the end of this year, 1st quarter of next year. My target right now for the conclusion, meaning when this motive phase completes, is going to be just shy of 2,700. That's been my target for a while. I did revise it once mid-year because initially I was looking for 2,500, and once we got close to that, I realized that that was a little bit too modest of a upside target. And right now my target is and has been $2,700. Not tomorrow, not next month, but by the 1st quarter of 2025. And that's really what I am looking at.
Throughout most of the year, investor demand has played a minimal role in the gold market as record central bank purchases and Asian retail demand have driven prices. However, analysts expect that investors will start to take a bigger interest in gold as the Federal Reserve looks to begin its easing cycle next month. Based on fundamentals, GaryWagner predicts that while a correction could occur at any time, the bull cycle still has momentum. Regarding Chairman Powell's upcoming speech at Jackson Hole, he emphasizes its importance for insights into the Fed's potential shift from restrictive to accommodative monetary policy. He anticipates the Fed will target rate normalization, reducing rates by about 2 percentage points over the next 3 years, from around 5.25% to 3.25%. In a recent note, UBS analysts stated, "Dovish Fed expectations, with UBS economists now forecasting 325 basis points rate cuts this year, the move lower in real rates, and a weaker US dollar have all been positive for the gold price." They also added that they don't believe gold is currently overvalued and cite macroeconomic factors, investor positioning, and market dynamics as factors that show there is potential for further price increases. Let's get back to the interview.
We're obviously in the midst, probably more than the beginning of a major bull rally, a rally that is historical in nature, in that since April, we've made, I believe, 4 record new all-time closes. And that is startling when you consider that. We're above 2,500. As you said, we're down a little bit today. But I look at this as it was a necessary and needed aspect to gold because it had been going up so strong, so fast for so long without releasing the steam, so to speak. It worried me that we could see a really strong correction. This is what we want to see, in my opinion. But we are in the midst of a historical bull cycle that has taken gold above $2,500 per ounce. I believe that there is definitely steam left, although at any moment, for any reason or no reason at all, we can see the market correct. Of course, we have a speech by Chairman Powell tomorrow at Jackson Hole. So market participants are going to look for more insight into what the Fed will do in the future. The minutes were released this week. And so for that reason, we've gained tremendous insight in that the vast majority of Fed officials believe that it is appropriate at this point to begin cutting rates. And to me, what is most important is not that they're signaling a rate cut in September. It's much more than that. They are signaling a major pivot from a highly restrictive to a highly accommodative monetary policy that's end goal is interest rate normalization. And so what I mean by that is it's not a matter of cutting rates by 1/4 or 0.5% in September. It's a matter of their goal that they have laid out in the Summary of Economic Projections, the SEP, that includes the dot plot. And if you look at the March and the June editions, the March was looking for a total of 3 rate cuts this year, a series of rate cuts through 2026, taking us from current levels, which is 5.25 to 5.5, down to what they're calling normalized rates, which used to be 2%, but now they've kind of raised that to 3%. So they're going to want to reduce it by about 2 full percentage points, from about 5.25 to about 3.25 is my sense, and do it over the next 3 years. We have an interesting scenario of forces moving gold to the levels we have seen. And of course, at the forefront is action by the Federal Reserve. But you also have the fact that central banks have been accumulating large amounts of gold, replacing their currencies, their fiat currencies, with this hard asset because of the stability of it. You've got tremendous interest by retail and institutional investors. Most hedge funds at least have a little toe dipped in the water, so to speak. Part of that portfolio contains gold, whether it's through paper, electronically traded funds, or futures trading. They are participating. In China, it's been reported, not only we've all heard about the central banks and the large amounts they've been accumulating, but I read an article recently this week that talked about how the retail investor right now has been utilizing gold as a primary asset group to put their money in as a store of wealth and a stabilizing, because in China, they're hesitant to go into the equities markets, hesitant to put them in interest-bearing assets. And so the retail investor has been very aggressively accumulating gold in China. India has always been that way. So you've got a multitude of factors. Add to that the geopolitical uncertainty, Middle East, Russia and Ukraine, that's still ongoing. So you've got a number of things that have moved gold to these historic levels.
While Eastern buying has driven gold to these heights, Western investors are now flocking to the metal as the shift to easier monetary policies begins. Unlike previous gold bull markets, this rally is occurring under unique circumstances, raising the question of what factors could halt its upward trajectory. Will gold continue its bullish run, or do you think we could see a significant correction in the near future? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.